Okay, lots to talk about today. I'm going to run through it pretty quickly. If I'm speaking too fast, I'm already going to apologize in advance, but tons of data to cover. So, Liberation Day has come and passed, and it has been fireworks for the past few days. We've had the stock market lose about 15%. This is probably the fourth biggest loss in the history in a 3-day span. We've had treasuries fall off a cliff, giving us the best interest rates we've seen in probably about 2 months on Friday, yet to be reversed. And now we have the highest interest rates we've seen in about 50 days, in combination with the spread not liking the certainty, moving them up even higher. So why is all this happening? Why are we doing tariffs? What can we expect for interest rates in the near future? So first, let's break down tariffs. Again, as we know, tariff is simply just a tax, a fee on imports. Any country can do it. Obviously, why are we doing it? Why is the Trump administration enforcing tariffs? Well, there's lots of reasons, but we'll go over the top three. First one is reshoring. They want to basically, if you have imported goods cost more money, then what does that do? That causes consumer prices to go up. They want to stop stop foreign countries bringing in these imports, and they want U.S. to manufacture more goods here locally, okay? They want to bring back more employment to the U.S. So reshoring is a big one. Second one, of course, Trump has talked about, it is revenue. You charge a tax on this, you can increase the revenue, you can then maybe offset taxes, things like that. That's obviously still to be determined. Then the third one, the wild card one, which again, we're having the negative effect, and we don't know if it's true, is that we want to bring down the U.S. 10-year Treasury because we want to refinance some of our long-term debt. Again, they don't want to cripple the economy, but they do want to lower these Treasuries so they can refinance this debt. Remember, we have all this debt coming due in the next 12 months. We're $36 trillion in debt. Well, if we refinance it at a 4% interest rate rather than a 5% interest rate, that saves us $500 billion a year in 4, 5, 6, 7, 8, 10 years. So they're trying to do this. They're playing the longer game. These are the reasons. However, there's clearly counter arguments to all three of these. The first one is reshoring. Unemployment rate's 4.2%. This is the lowest it's been. I mean, it was 3 point some last year, but 4.2% is a historically low level. We have jobless claims still incredibly low. We have all these jobs being added. Labor market has been fairly robust. We're seeing signs of weakness, but we're not seeing real signs of deterioration yet. So reshoring, not to mention, can we really even create these goods at the same prices some of these other countries can? If we can't, what does that cause? That means we're going to be creating these items at a higher price because we have to pay American workers more money than some of these foreign countries pay their workers. Again, I'm not trying to get political, but that's just the truth, right? So if we now have to raise our prices to create these goods, what happens? Okay, that increases the prices. That then directly affects the U.S. consumer. So is reshoring really even what we need with our robust labor market? Not to mention the younger generation right now is not really leaning towards that in regards to their employment sector. It's not what they really want to do. In addition, revenue. Obviously, the counteract to that is cool. That's great. We want to incorporate, we want to generate more revenue, but obviously we can see retaliatory tariffs. So that means it's going to raise the prices. Who do those raised prices happen? Cool. The government's going to generate more revenue, but now the consumers are going to be spending more money due to the inflation, due to our tariffs and retaliatory tariffs. So great revenue, but cost the consumer more money. Then, of course, refinancing the debt. We'll dig into that here in a second, but we've seen the stock market really crumble over the past few days, kind of push back up today because of the 90-day pause. So let's dig into this. Those are the three most important reasons why we are doing the tariffs. Okay, now let's dig into interest rates. Why have interest rates reverse course? Typically, when you see the stock market plummet, you see a lot of liquidity exit the stock market. They recall what is called the flight to safety. You see the money then filter into bonds. It brings down treasuries, thus bringing down lower interest rates. That's the game plan, or that's one of the theories that we just talked about. And we had that on Friday. And an absolute reversal. As I mentioned, the highest interest rates we've seen in 50 days, and all within a span of 72 hours. We literally gained 0.5% in interest rate in 3 days. Painful for the mortgage industry, painful for homeowners, painful for everyone out there. Especially if you're quoting, if you're getting quotes on Friday, those quotes cannot be offered today on Wednesday. So let's dig into why is this happening. And the best way to explain it to me is kind of go over what happened in 2018, 2019, 2020. This is not the first trade war with the Trump administration and China. In 2018, Trump's first term, we had a trade war with China. We imposed tariffs because China has a bunch of intellectual property theft. Essentially, again, we engineer all these items, we then ship it them. They then can reverse engineer these items at a cheaper cost. And if they do it at a cheaper cost, they can sell it to cheaper than what we would. That's IP infringement. We wanted to stop that in 2018. Okay, so we did these tariffs on China for these imported goods. Guess what? They hit us with retaliatory tariffs, and when they did, that was heavily focused towards agriculture. When that happened, guess what? The U.S. actually had to bail out farmers. We had to basically print $28 billion because their economy slowed down because of those tariffs. Well, theoretically, think of the same concept, but on a level that is 10, 20, 30x of what happened in 2018. We're doing tariffs on every nation. Again, pause right now for 90 days, but we're getting really aggressive with China. China does import a ton of goods into this. The U.S. manufacturing, 14% of goods come from foreign countries. That's a lot. 14% of GDP is through foreign goods. That's a lot. If we then are forced to print money because tariffs have the ability to slow down the economy, what does that do? That causes a major risk for Treasury prices. Us printing more money increases. It inflates Treasury prices, why you're probably seeing a reaction. There's obviously, of course, other reasons. People have a belief that obviously hedge funds who've been obliterated in the stock market had some margin calls. They had to sell their treasuries to then, cover their margin calls. You're seeing other reasons, risk of inflation. Risk of inflation, will the Fed have to hike interest rates? Obviously, that's not what we're seeing. Fed is projected to cut interest rates now. But essentially, it all boils down to the treasuries. In addition, China is one of the largest holders of U.S. treasuries. If they're in a tariff war, and one of those theories was, hey, we want to get the 10-year treasury lower so that we can refinance our debt. Guess what? Let's sell our treasuries. And if we sell our treasuries, what does that do to the U.S. 10-year treasury? It goes up. It's the opposite. It's the counter effect. Not to mention all these other countries currently experiencing these tariffs. It is a slowdown in the economy. It is a slowdown in all economies, right? Well, normally if you have a slowdown in the economy, what do you need to do? You need to stimulate your economy. How do you stimulate your economy? By printing money or by selling assets. Guess what? A lot of foreign countries hold U.S. 10-year treasuries. Treasuries are, of course, the bedrock of the United States of America. We are the good faith and credit of the world. We are the reserve currency. But if you sell these, that brings treasury prices up. It is doing the opposite effect to mortgage interest rates. So we will probably continue to cover this heavily over the next few weeks. We have some more to talk about, but we'll leave that here for you guys today. And if you have any questions, feel free to reach out.